and we'll get rolling. So the first thing that I want to highlight from an executive summary standpoint is to really reiterate what we're looking to accomplish with this fund and drive home kind of the thesis of this offering. And fundamentally, what I really want to highlight here is the high level perception of a vehicle such as this fund, where we're pursuing small multifamily assets, where it's a much more inefficient market, primarily unsophisticated sellers, brokers, buyers, and players, and really compare what we're doing here to the institutional level passive investment opportunities that I think many of the folks on this call are probably most familiar with. And when I say institutional, to further define, I mean, 100 plus unit deals that are managed by on-site managers, where the brokers, buyers, sellers, and service providers that actually work on those deals being far more sophisticated, far more experienced. The high level kind of pillars of this fund are built around the fact that we are focusing on an inefficient segment of the marketplace. And we are utilizing what we define as like our special sauce in the Aligned Real Estate Partners business of sourcing deals direct to seller as really how we're creating a significant edge here. In addition to the fact that we're managing these properties with our in-house management company, separately branded, titled Blue Door Living. So I think it's almost just the first thing that I really want to mention here is that for the LPs on this call and for some of the investors that may be evaluating this deal in conjunction with other passive investment opportunities, such as these larger deals, it's almost an apples to oranges comparison. And they're really, at least in my experience, being in the business, I personally haven't seen many offerings like this that have a very narrow focus, both from a geographic standpoint, we're talking about New Hampshire here, and from a property type and unit size, kind of deal size standpoint of what we're talking about here, which is predominantly 500 grand to $5 million in deal size. It's historically been extremely challenging for passive investors to participate in those types of deals because they're not economical to raise for on a deal by deal basis, given the complexity from a legal standpoint, given the fact that there is some truth to the fact that it takes the same amount of time to put together the legal docs to raise money for a 5 unit deal as it does a 100 unit deal. But through this fund structure of raising with a fund model, we're able to actually bring outside capital in from retail limited partners, retail passive investors into this investment type, which is, I think, fundamentally what we're most excited about. TJ, I'll let you share some thoughts on that as well, because I know that you can speak to it from the perspective of someone who's raised capital for some of those larger deals.
Yeah, so for me, it's a bit of a full circle moment to put this fund together because some of you may know that my entry into this facet of real estate investing was through finding Axel's wallet on the street. And I remember that when I found your Instagram page that detailed exactly this strategy, but just 5 years ago, on buying discounted deals, building the infrastructure to manage them, I remember thinking to myself, one, that's exactly what I wanted to be doing, but didn't have the access to do it myself. And two, I had two choices. I could either go and build something that was very similar, but in practice, that would have been very difficult. And that's why you don't see this very often, because it's very hard to build a business like this. Or two, I could find ways to add value to the business that you already had, right? And thankfully, I went that route first as a limited partner alongside you, and then eventually joint venturing and a number of things and raising money alongside each other and co-GPs and the rest of it. Um, for a long time, I did other deals, like you said. I've raised a bunch of money for all things all across the country, a couple 100 unit buildings. But I just want to emphasize how unique an offering like this is and how we haven't been able to put this together up until recently. And if we had been able to, this is exactly what I wanted to invest in the first place. And there's no strategy that I would rather put my name on and put my friends and family's money into. And I'm super excited to be here.
Love it. No, I joked that that was the best decision I've made is losing my wallet. It's kind of it's funny how that comes full circle. So I'll dive a little bit more into kind of the high level executive summary here. We're going to be diving more specifically into the market in a moment, the investment structure, the fund structure in regards to prefs, splits, and then the timing of when we're raising capital, which is a really key part of this investment. But really to highlight very quickly here at the top the types of deals that we pursue, and I just gave a little bit of insight into that, which is from a purchase price standpoint, call it 500K to $5 million in deal size. From a unit sizing range, that's anything from 3 units up to 40, 50 units. However, the vast majority of deals that we're going to acquire within the fund itself are likely going to be 3 to 10, 3 to 15 units, really that 500K to a couple $1 million in deal size. Those are the types of deals that we most predominantly source through all of the direct-to-seller marketing and prospecting that we do. Our acquisitions manager, Justin, banging the phones and calling all week, all the direct mail that we send, all of the content that we create and distribute both on social media and then through our email list. In terms of all the special stuff we're doing to find deals outside of waiting for the brokers to call us, the most typical deal that we find falls within that range. And then in terms of the what that actual deal looks like from a business plan standpoint, most of the time, the vast majority of the time, and we're going to talk about the illustrative first deal that we're closing here. We're buying stuff from long-term owners who are looking to retire, who are maybe getting a little out over their skis operationally. They probably self-manage. They're just realizing that maybe real estate's not for them, and there's some level of motivating force behind them looking to sell other than purely maximizing sales price. And I know a question that a lot of folks have is, why do you get good deals? What is the reasoning behind that? Why is this an inefficient part of the market? Why would someone sell you a property at below market value? And I'll discuss that a little bit more by using the deal that we have under contract as a great case study and a great reason for that. And I'll touch on that here in 10, 15 minutes. But we get in there, we work through very simple cosmetic value add updates. We improve the quality of management. We're spending the vast majority of our units on what we call true value driving renovations in terms of what actually drives rents and NOI. So common area improvements, in-unit improvements. We like to focus on deals that have a light to moderate value add scope, which I define as a small to moderate per unit CapEx budget. We're typically not pursuing deals where we're tearing apart every single floor plan and gutting and moving floor plans and doing a roof and doing all the heating systems and doing siding. Our special sauce is we want to find those deals where we can do our light to moderate value adds and then downloads our more efficient management process onto the asset and then create some value there. And again, this is all done through our in-house management company, Blue Door Living. All right. So why fund, right? And I think there's again, I touched on this a little bit at the top where it's really hard for LPs to invest in these small deals on a one-off basis because it's disadvantageous to put together a single asset raise or deal for a 6-unit deal, an 8-unit deal, a 10-unit deal, right? Because if you're paying 500 grand to $1 million in purchase price and you're spending 10, 15, $20,000 on legal, you're dragging the returns at such a significant level that the returns no longer become attractive. Not to mention the administrative complexity on the sponsor side and having to manage 10, 15 of these raises and deals across, call it a 12-month period of time. So one, the fund vehicle just allows us to do this period, right? In terms of giving our base of LPs and our investors an opportunity to invest in these types of deals. But there are some other benefits as well, which is investors achieve some level of diversity in terms of, or diversification, I should say, in terms of spreading their money across a handful of different properties. And while we're still focusing on one broader geographic area in terms of the state of New Hampshire, there are multiple different pockets of New Hampshire, right? As there isn't any larger market. So southern New Hampshire, the seacoast of New Hampshire, all the way up to central New Hampshire, there are attributes to each of these markets that do provide some level of diversification. Additionally to that, we have the option to refinance properties periodically, whether it's individually, whether it's packaging multiple properties that we acquire into a portfolio and refinance. We can sell some individually as we maximize the value and if it makes sense opportunistically to sell. And along the way, we can return capital in a more predictable and periodic on a more periodic basis and a predictable basis than just buying one single asset. Outside of that as well, as I've mentioned, the vertically integrated team is huge specifically for this strategy. Generally speaking, it's great to invest with a sponsor that controls the management infrastructure within the deal. because it reduces execution risk. There's some cost savings typically associated with that as well. But specifically for this strategy of buying a large number of smaller deals, in the industry terminology we use is scattered site portfolio. It really helps to have a management team that is comfortable and familiar with managing multiple different properties in, at multiple different addresses, um, versus just having one property with an on-site manager. You can typically get away with working with a third party there, and a good third party can generate similar results to an on-site, or I should say, an in-house management team, because again, you just have somebody sitting in the office, property manager, leasing agent, etc. But when you venture into the scattered site world of smaller properties, if you don't have a really tech forward, really dialed in management process behind the scenes, it's easier for a third party to screw that up. And I think the sophistication of the third party management companies that manage these types of properties is much lower on average than the third party PMs that manage larger institutional size assets. Last thing I'll note here, right? This structure allows us to capitalize on our direct to seller deal flow, which is really the special sauce here. And it all flows back to there's really no opportunity for investors to work with us on these types of deals outside of a structure like this for some of the reasons I mentioned. TJ, anything you'd like to add to that?
No, I think you got it covered.
Alrighty. So a lot of you are familiar with both TJ and myself. Long story short, have done a lot of these deals. Since I've been in the business, I've done 50 plus deals within the investment scope of what we're going to be buying within this fund, totaling 475 plus units. Collectively, TJ and I have raised over $20 million with zero losses. And I think the big important additional piece of intel here is no capital calls, no raising additional equity, no pref equity, none of the bailout equity stuff that allows someone to say they haven't lost any investor capital, but behind the scenes, there's a lot of distress in their deals. The deals that we've closed over the last few years are performing extremely well, and we'll quickly dive into that. And there's a lot of language in this deck, in addition to that as well. Um, TJ, just to make sure that you touch on anything I miss here, anything you want to add there as well.
I would just say for myself, for those who don't know me, so my background's in engineering, going back 8, 9 years, graduated MIT and went and worked at a startup. Startup was bought by Amazon and worked there for a long time while I was building a real estate business on the side and got linked up with Axel a couple of years ago. Well, actually 5 years ago to be exact. And again, like I said in the beginning, really liked the business he was building. To date, we've partnered, I think, on 8 joint ventures. And it's a strategy that I just keep coming back to that is something that I want to go all in on personally. So I don't work in tech anymore. I do this full time. And we've really narrowed our focus over the last 6 months to just do what has been working for us. And one of those major things is New Hampshire multifamily.
Love it. The only other thing I'll mention as well, just as it relates to our PM company, Blue Door Living, we don't have a significant amount of material in this deck regarding the management portfolio size and kind of the team behind the scenes at our management company. This number is actually a little outdated. We just crossed the 750 unit mark in terms of the total units that we manage. Obviously, a lot of those are internally owned, but we also do third-party management as well. Which has allowed us to build a much larger, much more robust team. We have incredible density in the areas that we do manage. So, for example, like Manchester, which is the largest city in New Hampshire, we manage a few hundred units in Manchester specifically, and we have an absurd amount of data from a rent comp standpoint, from an operational expense standpoint. We have a very deep well of vendors, GCs, et cetera, service providers that we leverage. So we're not just managing our own stuff, we actually manage other investors' assets as well. And that allows us to build a much larger team where I think we just crossed 10 in-office employees, including our virtual staff. We're up over 18, 19 right now. So we're building a great team there as well with some infrastructure. Overview of New Hampshire. Some of the highlights in terms of how to think about New Hampshire as a market for those of you that may not be from the Northeast. We love markets that blend population growth, job growth, and rent growth. And rent growth is typically occurring downstream from these other two dynamics, but markets that pair population and job growth with minimal supply. Like that's kind of the equation where you get population growth plus jobs minus supply equals rent growth, right? And um, that is really the equation that is continuing to drive rents in New Hampshire. Not only just rents, but as well as investor interest from out of state. I think outside of just the stats regarding the market that we can share, which is we have a lower vacancy rate than the national average, lower vacancy rate than what's considered to be a healthy rental market. Typically, folks think of that as right around 5%. New Hampshire as a state sits at 4, and then I'll even get a little bit more specific. The markets in which we predominantly operate, such as Nashua, New Hampshire, Manchester, New Hampshire, the seacoast of New Hampshire, typically hover anywhere from 2.5 to 3.5%. Those particular regions, so they sit even under 4. We're still seeing rent growth in New Hampshire, and I know that I've spent some time comparing this offering to a lot of what is typically available in the passive investment landscape from a multifamily standpoint of southwest located deals, Arizona, Texas deals, southeast deals, Florida, Georgia, North Carolina, South Carolina, etc. Um, we typically see the Northeast in general, and then New Hampshire within the Northeast leading charts nationally from a rent growth standpoint. Maybe not number one, but typically in the top 10, alongside many other Northeast markets. And a lot of it is due to the fact that it's just we don't see as much supply as a lot of those more true high growth markets from a population growth standpoint. New Hampshire does have positive population growth, not listed on this slide, but highest population growth in the Northeast U.S., which includes all of the states from Maine, Vermont, Massachusetts, New York, Connecticut, Rhode Island, really all the way down to Virginia, basically. New Hampshire has the highest population growth as a percentage. And as a result, again, blended with minimal supply, we're undersupplied in New Hampshire, about 23,000 plus units short of what would be a healthy equilibrium. Rents continue to drive. I'm going to bounce past this because I just touched on a lot of this here. So now we'll spend some time talking about the actual investment structure. And this is one that I want to make sure that everybody understands because this is a slightly more complex structure than just a single asset syndication, given that we are raising in a fund vehicle here. High level, first thing I want to note, this is a very fee light offering comparatively to what is quote unquote markets out there in terms of where LPs can invest their money passively. We're charging a 2% acquisition fee based on purchase price for the deals that we acquire within the fund, but those are the only fees that sponsors are taking here. No disposition fees, no loan guarantor fees. And again, another important thing to note is TJ and I are personally guaranteeing all of the debt that we're using to finance all of the deals that we buy within this vehicle. Again, much different than a larger institutional deal with Fannie Mae or Freddie Mac debt that's non-recourse, where there's no recourse to the sponsors. We have recourse. If things go sideways, they're coming after our own personal balance sheets. And again, that's primarily driven by the small nature of the deals that we're pursuing. There's really not any availability of non-recourse debt. It's all recourse. So again, we're still not charging any loan guarantor fees, disposition fees, asset management fees, no other fees other than acquisition fees, which I feel, I think we both feel that it significantly aligns the incentives across the board here. We're really earning our compensation from this offering once we get into the promote. We're going to be raising capital over the course of 12 months, and that's going to take place over 4 tranches at the end of the next 4 quarters. So the first tranche, the first round of fundraising is closing on July 1st. It's closing here in a few weeks. And we're incentivizing investors to participate before July 1st by offering a higher preferred return than the baseline preferred return in this document or in this offering, excuse me. So if you invest by July 1st, you're locking in a 9% preferred return with the same 60-40 split. The next round of fundraising will then occur at the end of Q3, so 10-1, and we'll be locking in a preferred return of 8 for the investors who participate in that share class. The next 2 rounds, January and then at the end of March, or I should say end of December, then end of March, will be compensated with a 7 pref and then a 60-40 above that 7. Important to note here that for investors that participate in, for example, the July 1st round of fundraising and they invest in the Class A share that offers a 9% preferred return, if these investors decide to invest follow-on funding in future rounds because they like how the fund is going, you like the updates, we're making progress, we're buying deals, things are going well, You can invest in the future into Class A or whatever class that you previously invested. So, for example, if you're an LP, you invest $50,000 by 7/1, and then you want to invest, an additional 25, 50, 75, whatever the number might be. You've already met the 50K minimum, and you can also invest at a future date, but still be grandfathered into the original share class of which you invested. So the reason that we're incentivizing folks early is one, because investors who act earlier have slightly less data than those in terms of how to evaluate the fund than those that invest at a future date. For example, the investors who invest maybe 6 months into the fund's life cycle, they'll be able to look at what we've bought. They'll be able to take a look at the, business plan progression. There's going to be some historical data for them to work with as it relates to the properties that the fund has already acquired, which is why we are incentivizing early investors to participate. Outside of that, very simple organizational structure. Assets will be acquired using the New Hampshire Multifamily Fund III LLC. Investors are investing into this entity, which will then go and acquire the properties that the fund purchases. We obviously have, lenders sitting between. TJ and myself are going to co-invest roughly $300,000. Again, we're personally guaranteeing all the loan docs. And again, the only fees we're taking are a 2% acquisition fee. And then obviously we have LPs that are funding the remainder of the required equity. TJ, anything I missed there that you also want to highlight?
I would just say two things. So one, all LPs, this is a pass-through offering, so you get the tax benefits as well that come with owning real estate. It's all distributed, pass-through pro rata, depending on your ownership. And then the second thing that I would just emphasize is the conviction, right? We wouldn't guarantee the debt, we wouldn't co-invest, we wouldn't heavily backload our compensation and doing all the work if we didn't really believe in what we were doing. And that's the God's honest truth, right? So that I think that's the biggest takeaway on this slide for me is that we are really trying to align our incentives as much as possible with our investors.
Yeah. And I know that again, it's not typically discussed when you're looking at these types of offerings on a webinar and docs, but the recourse nature of debt really, really ties TJ and I to this deal, right? When we see a lot of the deals that are being foreclosed on, unfortunately, I'm an investor passively in some of those. I don't know, some folks on the call maybe as well, that were bought in Texas and 21, 22, or Florida or Arizona, whatever the market might be. The sponsors who have non-recourse debt can walk from those deals with no recourse. We don't have that option here. We're personally guaranteeing the loan balance of all of these deals through the lenders that we're working with. So our objective here is to execute at a very high level. Well, first, I should say, to buy extremely compelling deals from a purchase price standpoint, execute them extremely well so that we can get into our profit split, which only occurs after we return 100% of investor capital plus any unpaid preferred return. And from that standpoint, our incentives are extremely aligned, and we're not really earning a lot of money along the way outside of a small acquisition fee when we close. Financial projections. What I'm going to highlight here are we're underwriting deals at the property level, basically at the project level to 8% plus stabilized cash on cash returns, 18 to 21 IRRs with a 2 plus equity multiple, which then filters down into these net returns here. Again, something that I really want to highlight here and a real key point that I think is important to highlight is the timeline to complete the business plan on the assets that we buy. When we underwrite the deals that we buy, we're typically underwriting a refinance at the end of year two. That's typically when we're projecting the capital events on the deals that we acquire. In reality, it doesn't take us that long to implement a business plan. It typically takes us a year. For example, I'm going to talk about 39 Ashland Street here in a moment, which is the first deal that we're buying in the fund. It's only going to take us 6 months to implement that business plan. We buy, a lot of the assets that we buy have month-to-month residents. We're able to get in there, either access units or bring rents to market, implement our business plan very quickly. And we're in a position to execute that capital event, whether it's opportunistically selling the property or refinancing and then returning capital to investors in a much shorter time frame than, for example, buying a larger multifamily asset, right? 100, 150, 200 unit deals are like turning around a cruise ship. versus turning around a boat. So it's going to take you a lot longer to actually arrive at the finish line and then execute that capital event. And I think a function of being able to outperform this projected IRR is just executing capital events faster, and that's what really drives the velocity of money, which is and what will likely allow us to outperform the figures that we're communicating here. Other thing I'm just going to note is discounted management fees. Specifically, and I just want to highlight this for the folks, again, who are maybe used to looking at larger offerings. This 6.5% is in place of payroll. So larger multifamily assets, you're looking at a P&L. There's the payroll for the on-site manager, and then there's some management fee above and beyond that to manage that on-site manager that's being charged by either the sponsor or the third-party management company, of 2, 3, 4%, whatever it might be. This 6.5% is collected on gross revenue by Blue Door Living as any property management company would collect, but is actually a significantly discounted fee to what the market rate would be for a strategy or a property type like what we're buying, which is typically 8 to 10% plus. So not only do we have the value add of managing these in-house, or I should say the advantages in execution for managing these in-house, but we're also charging a significantly discounted fee at the property management level. It's just a sample return of what the returns would look like year over, I should say, each calendar year for different investment sizing. I'm not going to spend a ton of time on these slides here. This is just a deep dive into my personal portfolio and then portfolios that I've been a lead sponsor on. And TJ has been involved in a large number of these deals as well, which is outlined here. So again, if you want to dive into like what we've done, you can just run through these slides. The whole thesis here being like we've done this a whole bunch of times. We've bought a lot of these deals, sold a lot of these deals, operated a whole bunch of these deals, and done really well. I'm not going to dive into these specifically unless there's something that you would like to highlight here, TJ. But at a high level, what I'm going to share outside of what folks can read in the deck is these are deals that we have not gone full cycle on in the sense that we have not sold and returns the remainder plus profit share of investor capital because we're working through longer term holds on these properties. But these are deals that we've bought with this sponsor team and where we've executed some version of a capital event, returned a portion of investor capital, and basically kind of sharing how these deals are going on an ongoing basis outside of the fact that we just haven't sold and technically went full cycle.
Yeah, I'll highlight here, like you'll probably notice a theme with these deals. Our goal is to stabilize these properties, refinance them, capture that new value that comes from our efforts, forcing appreciation, renovating units, but also from buying properties at a good price. And then our goal is to return that capital to our investors. And again, you'll notice that theme with a lot of these deals. If you go back a slide, I'll just
Hmm.
talk through two things with Lakeside Landing. So this is a deal we bought 2 years ago, and this deal highlights one, like the management play that we're going for, where we're trying to buy deals that are mismanaged. This is a deal where the grass was 3 feet high. There was a lot of tenant issues and rents were quite low. So we've been able to take the rent roll there from 47,000 up above 70,000. And that's even with having 26 five-star reviews on Google at the property. The second thing to highlight here is that with this fund, we do have the option to joint venture with other great operators that exist in New Hampshire, people that we've done business with. We have a third partner on the Lakeside Landing deal, Mammoth Properties. They're phenomenal. And this fund has the ability to go and work with those types of groups on a deal by deal basis, which helps us a lot. It'll help us to deploy capital and it helps us to buy deals that might not fit specifically into what Blue Door is best at managing at, or areas that maybe we don't have as much of a presence in. Anything to add there, Axel?
No, no, I think that's great. Long and short, I think the thesis statement of what we're trying to communicate with both these two slides in terms of our ongoing deals and then the track record slide is like this is such a rinse and repeat type of asset for us. Like buying these deals direct to seller, implementing a light to moderate value add business plan is something we've literally done 50 plus times. And that's just the objective of what we're trying to communicate with some specificity, I should say, around what we've actually bought. In terms of risks, so I'm just going to jump to number four here, because I'll just call this out as a quick risk. Um, a lot of LPs find themselves uncomfortable with the nature of what a fund is investing in because they can't define the asset that they're investing in. They can't look at the pictures, they can't look at the underwriting, etc. Um, how we're mitigating against that is we have a very, very narrow focus with this fund and with this vehicle. We're buying small multifamily deals in New Hampshire. Like it's a very narrow focus. For example, a lot of funds just raise a fund, they leave their investment criteria broad. We're going to go buy multifamily in the Northeast. And they've got 4 states in there, 5 states. They have the ability to work with a whole bunch of different third-party PMs or outside vendors. They can buy anything from 20 units to 200 units. And LPs truly don't have a sense of like what exactly they're investing in. We've intentionally narrowed down the investment scope here to a level of which, uh, in terms of what we're trying to achieve, which is an LP who is very, very comfortable with what they are investing in, which is small multifamily in New Hampshire. You're going to be in the New Hampshire market, which we've talked about, and you're going to be buying small, inefficiently operated properties that we source through a lot of our special sauce proprietary means. Um, in terms of outside of that, a lot of this is kind of standard from a risk standpoint that you'd see in many other multifamily offerings. Um, we're obviously sourcing deals in a competitive market. Every market's pretty competitive nowadays, it seems, but New Hampshire is a growingly competitive market. I briefly mentioned that during the market overview comments where about 5, 6 years ago, New Hampshire was just a whole bunch of guys from New Hampshire chasing deals. And now it's a whole bunch of guys from New Hampshire, plus a whole bunch of guys from Boston, plus a few guys from New York, chasing deals in New Hampshire, which is great for the folks who have deep, extensive local relationships because there are far more buyers and is significantly more liquidity both on the lending side and the sales side when we go to actually execute a capital event. So that's of benefit to the folks who are deeply plugged in and are doing a lot of what we're doing to find deals. I actually view that as a positive, but obviously it's a competitive market, and that's something that we're communicating here from a risk standpoint. Do you have anything else you want to add to this one, TJ?
Well, I'd say this year 2025 from an economic standpoint, it's been a volatile one. I think anybody's noticed that, and I've had a lot of questions surrounding things like recession, interest rate risk, and while those things all do matter, I want to highlight that the the business plan of this fund is much more of a micro bet than it is a macro bet, right? Like this fund
Mhm.
works because we can buy deals at a great price, because we can manage those deals well, and because we have access to capital in the form of, lenders that will lend to us on the stabilized value of those properties. And we'll talk more about that with Ashland Street, but I think that helps to insulate us from a lot of the macroeconomic risk. It's still important, of course, and it's something that we track, but it's not the main thesis of this fund.
Yep, that's a good comment. So, a quick timeline overview. So, years 1 to 2 is when we're raising capital, we're deploying capital, we're executing our business plan. For example, there's going to be some deals where we can execute a capital event before the end of year 2. Ashland Street, we'll be able to refinance that property in 12 months. Just it's a 6 unit deal. It's not going to take us too long to run through that business plan. We'll be getting to that finish line sooner than later. But for the properties that we buy towards the later parts of the capital raise process within the fund, call it, early next year, for example, takes us out into the middle of, year 2. And then at the end of year 2 is when we're going to look to execute the capital events on the majority of the properties that we buy, which is defined really here, right? And that's when we're going to be in a position to start returning capital. Years 3, 4, we're going to continue operating, making distributions. 4, 5 is when we prep the portfolio for, maybe another refinance or the eventual sale of some of these properties. And again, a value of buying a larger number of assets is that we're able to sell some, refinance some, etc. We have multiple exit options. And then years 5 through 7 is when we're returning the remainder of investor capital, winding down the fund, and actually exiting all of the assets that we buy.
Yeah, we got one comment about distributions, which might be worth covering here on when we would be starting distributions. You want to cover that quick?
Yeah, I think we'll likely start distributions 9 to 12 months into the deal. I think for a lot of the assets that we buy, it's going to take us that 6 to 9 months to arrive at a point of stabilization to where there's sufficient debt service coverage, sufficient yield on cost to begin making those distributions. Um, I think that our goal is to find ourselves in a position where after we've raised the entirety of the fund over the first 12 months, to meet pref in year two, with the goal of year one making a distribution or two that allow us to shave down the accrued pref in that first year. But the nature of the fund vehicle is that we want to be careful with our cash and make sure that we deploy it in a timely fashion to make sure that we're not raising capital and then sitting on capital for a long period of time. So we want to make sure that we carefully manage our capital throughout that first year, make sure we get it deployed into great deals, work through the business plan implementation. Later part of that year, month 9, month 12, we start distributions with the objective of years 2 through 5 to start meeting the preferred return from a distribution standpoint while returning capital along the way. And from a frequency standpoint in the future, quarterly distributions is what we're comfortable committing to from a timing standpoint. Let's talk about Ashland Street here. So, big question. Why are you guys finding good deals? Why does anyone sell their property at a discount? Why wouldn't somebody hire a broker to sell their property? All very reasonable things to ask. This story is very emblematic of like a lot of the deals we buy, right? We've bought 15, 20 of these deals a year for the last few years, and a lot of them have some type of story that's similar to this. This is a 6 unit property. Our acquisitions manager connected with this seller via a cold call, built a relationship with her over a long period of time, a lot of periodic follow up. And out of nowhere, it was time for her to sell because she wanted to pursue a deal out in the Midwest. The story's fuzzy in terms of our understanding of it, but she had a significant motivation to sell, like out of nowhere. She really needed liquidity, and we made her an offer that was lower than 835. We started working through a negotiating process. She's like, I need to close this in like 3 weeks. And we're like, that's just not a reasonable timeline for what we're, for the price that we're willing to offer. Um, Long story short, the way that we actually ended up putting this deal together, because she needed liquidity to put down as a deposit on this piece of land that she wanted to buy. I personally lent her money as part of the purchase and sale agreement that was secured by a second position mortgage on 39 Ashland Street, the property itself, that I'll then be paid back, at closing on the closing statement. And that was a key negotiating point of the deal that actually allowed us to convert this into a contract to get our offer accepted. Um, and it's like stuff like that that's so out of the ordinary. That's like such a one-to-one. I got to solve a problem for this particular seller. She needs it solved right now. It's not even a thought to her to go and hire a broker, spend a week, 2 weeks while that broker prepares a number and marketing materials. That broker then spends another 2 weeks showing it to a whole bunch of buyers where they bug all of the tenants and piss them off. And then they go back and they yell at the seller who self-manages. And then in 60 to 75 days, 90 days to close. Like just that whole concept to her was just not even remotely an option. And her option was this guy can lend me a second position mortgage within a week of signing a contract. Yeah, I'll take your 835 number. Like that's oftentimes the type of deal that we're buying. And you can't find those deals at the 100+ unit institutional space. It's just not happening. There's too much capital, there's too much sophistication. They just don't exist. Other components of this is she just wrote down a rent roll on a piece of paper. We were like, hey, we need lease dates. She's like, I don't even remember what they are. She's digging up files and trying to figure it out. And we're asking tenants while we're there doing due diligence, hey, are you month to month? Can you quickly sign a piece of paper that verifies that? Like all of this stuff takes the person who wants to, who's willing to pay market and just disqualifies them from being able to do the deal. It also causes a lot of lenders to not want to get involved in the deal. A huge advantage of what we're doing here is we have extensive relationships with local banks and credit unions. Business, or I should say banks and credit unions that I've done 10, 15, some of these deals with. And because we're personally guaranteeing the debt, it goes so far when they take a deal like this to their credit committee where it's a little bit fuzzier around the edges from a paperwork standpoint. They're like, hey, purchase price looks crazy. We haven't seen anything sell under $1 million in Manchester that's 6 units in a year, or excuse me, in 6 months, which is literally a stat here in Manchester. There hasn't been a 6 unit that sold in Manchester for under $1 million in the last 6 months. You guys got it at this sweet price, but like, I don't know, we're a little uncomfortable because we don't have like a trailing 12. We don't have, we're not familiar with you. We're a little bit worried about the risk profile of the deal. Whereas a lot of the lenders that we work with, because we're personally guaranteeing, with a balance sheet that makes them far, very comfortable with the loans, especially compared to the loan size. But they're like, yeah, we can get this through underwriting. We can get this through credit. It's a very relationship driven process. And we're able to secure solid debt, 6.5% is our interest rate on this 30-year AM. We're getting some construction financing that a new buyer may not get, or somebody who's not comfortable with making decisions with slightly less information that they would like to have pursuing a deal like this. Here's some examples of nearby, within a mile and a half, close dates, price per units that they sold at. Um, Long story short, we're paying just under 140 a unit. We're going to be roughly all in at 162. We only really have to heavily renovate 4 units. The other two are very light turns. Very minimal exterior capex needed, very minimal systems capex needed, with all signs pointing that this is something that will trade for 178 or appraise at 178 a unit once we're done. And this is really like the prototype for the deals that we pursue, both from a story standpoint and then a numbers standpoint. Anything you want to add there, TJ?
No, I just say that there probably isn't a better prototype deal for the fund because this is exactly the business plan that you've been running and I've been a part of for the last few years.
Yeah, exactly. Rinse and repeat. This is like not only, us as sponsors, but our management company, our team. Like we handle a lot of these renovations in-house now with our in-house maintenance techs. We get in there, we tear through them, we get them leased up. We're very, very comfortable executing deals like this. This is just some language from a rent-com standpoint. Again, I'll reiterate, market context here. We own, or I should say, we manage through Blue Door Living both properties that I personally own, that I own with partners, as well as, again, just our third-party management portfolio, dozens and dozens of units within a 1.5 mile radius of this property. We're leasing units, for example, in Manchester every week. We have a listing come up, and we're so in tune with what the current rents are because we have like the leasing stats. It's not like we're pulling up Zillow and going, hey, down the street they're leasing or they're asking 1850. I wonder if they're going to get that, or I wonder how many applications they've gotten or how many showings they've done, etc. We have extensive insight into the statistics and data behind where properties are renting in New Hampshire and all of the markets that we buy in, both through our internal portfolio and then through our third-party management portfolio. This is going to be representative of the type of debt that we get in a lot of these deals, most of these deals. Mascoma Bank is the lender on this, who we've done a significant volume of business with. I think I personally, at this point in time, guarantee roughly $20 million in debt with Mascoma Bank. They're very competitive with us. They want to keep working with us. Banks are incentivized to work with a smaller number of borrowers that do a larger amount of business because it significantly simplifies their underwriting process and their loan approval process because they just keep our financials on file. They just take it back to loan committee, and it's a very easy process. And they obviously see how we perform as well, especially on acquisition loans, because we're making our draw requests. We're telling them the rents that we achieve. They're pulling our financials at the property level, and they're extremely comfortable with who we are, and that allows us to get very competitive rates and terms from a lot of the lenders that we work with. In terms of sensitivity projections, TJ, I'll let you run with this just because I'm talking everybody's ear off. If there's something here that you want to highlight, I can add some comments too. But in terms of how to interpret this as an LP, I think some
Yeah,
commentary on your end is
yeah,
probably
sounds
helpful.
good. So when you see offerings, you'll notice that many offerings have one number tied to it that gives you an idea of what your return might be, and that's called IRR, right? And the thing about IRR is it's a number that is driven by many different variables, And then when you add on that we're doing a blind fund where we don't necessarily know exactly what we're going to be buying, um, I just want to highlight that it becomes harder to accurately predict like what the IRR might end up being. So you might ask, okay, well, how do we end up at a slide like this where we can say that, we're targeting 15 to 17% and that we're comfortable with that? And it's all built upon, again, our track record and what we've done in the past. Um, Again, our goal is to stabilize over 12 to 18 months, to look to refinance as soon as we can. That's a little bit driven by the market, but that's just what we've been able to do in the past. And some other key assumptions, I think vacancy rate's a huge one. So for our deals, we project 20% vacancy year one. That's because we're doing renovations on the units. We're actually looking for more vacancy so that we can get into units and turn them. But more often than not, that's a very conservative figure. Often our vacancy rate is a lot lower than that. And that's a huge lever for what our cash flow looks like and what our IRRs are. Anything to add there?
No, I think that's really helpful. I think that LP should always be aware of what sponsors underwrite as an exit cap. That's one of those key assumptions in a cash flow model that really drives like the IRR and the overall returns of a deal. The vast majority of the markets in New Hampshire, call it the biggest ones. You have Manchester, you have Nashua, you have the Seacoast region, which is, for those who are unfamiliar, about 30 minutes east of Manchester, getting out towards the coast. Um, Typically are trading at an exit cap rate of 6.75 to 7 right now, depending on the vintage, depending on level of renovation, specific neighborhood, etc. Some even at lower cap rates than that for properties that have been built more recently. Anything post like 1975 build in New Hampshire, that's not in a really bad area typically trades at a 6.5 cap, somewhere in that range, if not lower, if it's in a truly nice area. So we've built in some nice exit cap growth here, and then you'll see cap rate deviation, right? If cap rates expand even more and we end up, closer to 7.5, 7.75, we're still looking at a double-digit IRR, which I think is a compelling return for a strategy like this. All right. So in summary here, again, we're raising 4 to 6 million over the course of 12 months, which I covered at the about 10, 15 minutes into this conversation, $50,000 minimum. The one thing that I want to make sure I leave everyone with, and then I'll get to any questions that are in the chat here. Highly incentivized for LPs to invest by 7/1 and lock in the higher rate of preferred return. Specifically for that investment, but also if you have a desire to participate again in the future, you'll have already met the minimum. You can come in at a lower dollar amount, 25K, and you'll be tied to the class of share that you originally invested, which allows you to follow on invest. If you like the updates, if we're executing on the business plan, if you feel like it's a strategy that makes sense, you'll be able to continue participating at a more preferential share class. Not, preferential, not in terms of order of payout or the waterfall, but just in terms of the preferred return that's associated with it. Any final comments, TJ, and then I can answer a couple questions here in the chat.
Only other thing I'd say is that Axel and I are both investing with this first share class, both because that's aligned to our LPs and also because we want that extra 9% preferred return. So yeah,
Exactly.
that's it. I guess we'll open for questions now.
Yeah, if you have any, either, feel free to throw them in the chat. We did talk about when distributions begin. Another question here. If you invest in 10 to 15 properties over time, are LPs tied to some specific properties for refinance, sell, rents, operations, in terms of the distributions? Easy answer to that is if you are an investor in this fund, you are investing in all of the assets that the fund acquires, right? So let's say you are an investor in this first share or in this first round of funding by 7/1. You're going to be an investor in 39 Ashland Street, as well as everything that we buy between the opening of the fund on 7/1 to the closing of the fund on, 7/1/26. And everything that we acquire, you are an investor in that as an investor in the overall fund entity that is acquiring all of these assets. And then similarly, if you invest in 11 months from today or 12 months from today and you're sneaking in just before we close it, you are investing in all of the assets that the fund has acquired over that period of time. Um, and again, a reason for the incentivized preferred return is if you are an investor at the end, you can look at everything that the fund owns, right? And you can look at all the addresses, you can look at the progress we made on the business plans. You're acting with more information, but as a result, your preferred return is going to be a little bit lower, and your projected returns are going to be slightly lower as a result of that as well, just given the fact that there's a lower pref associated with your share class, which is again why we're offering an incentivized pref for those who participate early. What are the inception to date returns on New Hampshire Multifamily Funds 1 and 2? So these are both open deals. I'll quickly touch on the second one here. This is the title is a little different from like a nomenclature standpoint, but New Hampshire Small Multifamily Portfolio 2, which TJ and I closed back in February of 2024. This was 27 units. In 14 months, we executed a refi of just a few of the buildings, 4 out of the 7. And we returned roughly 20% of investor capital, which I define as a significant win. It's right in line with our projections for that. We have the ability to refinance the other 3, but we're looking at potentially selling 1 or 2 of those, maybe refinancing the last one after we've just finished up the last component of the business plan. Um, we did make distributions, obviously, along the way in that first year too. I don't have that number off the top of my head, but I can find it. I believe it was right in the range of 3-4% distributed on capital in that first year. Then we caught up on all of the accrued preferred return and made a subsequent return of capital with the proceeds from the refinance. Big thing is that our total basis is 3.9 and value of the properties is 5. So we've created significant equity, and that's just in terms of project cost versus current as is value, not accounting for this equity in comparison to the invested equity, right? Which is a much different analysis there. Um, the first fund we closed was all the way back in 2022, Aligned New Hampshire Multifamily Fund 1. Spent about $2 million. This is still open. We executed a refi, I believe it was late 2023. We returned 30% roughly of investor capital. We had 2 share classes in that deal, and we paid off the first share class, which was a higher preferred return pref equity. Um, and we're continuing to make distributions on this deal. We've been distributing roughly 6 to 8% each year to LPs that are participating in this. We've got plenty of equity in this deal, and we could decide to sell at any point in time the remaining 2 properties that we have within that vehicle there. I'm really happy with how this deal is going, considering we bought at a time when a lot of folks were buying deals that are not currently going well, which is not, early, mid to late. This is kind of right at the tail end of the real mania of low interest rate environment investing. And this deal is going extremely well. Um, just because I see another quick question from Alex, I'll just kind of get you out here if or just hit you with your answers before I hop. K1s, we issue them by late March every year. We're pretty consistent with that. By the end of March, we're getting our K1s out. Question from Mike. Do distributions begin accruing on investment or when the fund closes? So pref starts to accrue for each round, for each fundraising round at the date that it closes. Whoops, I should actually go to the beginning to illustrate this. So for example, if you are an investor in the 7-1 share class, the Class A share, I'm just going back to the timeline here. Bear with me. So if you are a 7/1/25 investor, your preferred return starts to accrue as of 7/1. So the round of when we close the fundraising for that specific round. If you're investing in the October, end of Q3 round of fundraising, as of 10/1, your investment starts to accrue, your unpaid pref. So it's at the end of each quarter, that's when we assign the close date to that particular round, which is when the preferred return starts to accrue for that particular round.
Yeah, just want to highlight there quick too that I know there's some confusion sometimes on the preferred return versus what the cash flow distributions might look like for a deal. And Axel mentioned this in year 2. we want to get to the point where we can keep current with the preferred return and we can pay, 7, 8% yields on invested capital. But that preferred return, it's separate from those distributions. It can be the same thing, but it's really just a hurdle rate by which Axel and I don't hit the promote. We don't get paid until we meet that hurdle rate each year, and it accrues over time when we don't pay it.
Yep, it's a good distinction. With a 50K minimum and a raise of 4 mil, roughly you're expecting 70 to 80 LPs. It's entirely possible that we have 70 plus LPs that participate in this offering. Many investors are coming in for larger than 50K. We'll have, a number of investors that come in for 100, 150, 200. The last deal that we raised for Sterling Realty Apartments, which we closed in December of 24, that was about a $4.2 million raise in change. I believe we have
I think
40,
55 LPs in
55,
that one, probably including
55
you
LPs
and
in that
Sean.
deal.
Yeah.
Yep. Yeah, exactly. So, yes. Short answer is yeah, we'll have a handful of folks who are participating.
Axel, I have no questions. You answered them as we went along, so thank you for that. I really appreciate you, how transparent you are, and thorough with your deck. So thank you.
Appreciate that. No, thank you very much. And I guess we'll give a chance for anybody else to ask any before I stop the recording here and we round it out. Again, I'm going to distribute this recording I mean, TJ and I will both distribute this recording to all of our respective investors and lists. So you can go back and review if you want to dive into something more specifically that maybe you missed, or if you joined late for some of the folks who joined late. But if we're good on questions, last call here, and if not, I'll stop the share here and we'll close out the call.
Yeah. Thank you all for joining. I know it's a commitment to join a call on a Thursday night, and we appreciate y'all being here.
Thank you both. Take care, gentlemen.
All right, everybody. Have a good rest of your night, and we'll chat soon.